Hey everyone, it is Chris with Anderson Business Group. Hope you're doing wonderful today. I wanted to go over really quick debt, and our largest debt are mortgages. Many Americans are saddled with credit card debt, student loan debt, interest debt that is very high, automobile debt, and our largest one in most circumstances is our mortgage debt. So I wanted to go over really quick how to pay off our mortgages, the good and the bad. So for a quick example, let's say we have a $200,000 mortgage at a 6.5% interest rate, 30-year loan. Our monthly rate for our mortgage and our interest would be $1,264. Now, this does not equate to property tax and PMI and things as far as that nature. That would be embedded into it, but we can address that at a later time. So if we look at how can we pay it off, if we just do the standard, which most people do, of paying the minimum amount for a 30-year between interest and our principal, we would pay $455,000. And if we look at it as adding an additional payment every year, we would cut it down to 24 years and 1 month. That's a huge savings. It would take us down to roughly $395,000, which equates to saving on the total mortgage interest combo. Interest is the one that we're worried about because the mortgage payment, the principal is going to be the same, but the interest that we will save is over $60,000. That is a lot of money if we look at it as that is our capital back to us. If there's two ways that we can do that. We can do it as, hey, every year instead of paying 12 payments on that last one or somewhere in there, I'm going to make an extra payment. Or I'm going to take that amount and I'm going to divvy it up, that $1,200, and I'm going to divvy it up equally amongst 12 payments. My personal favorite, if you want to make one extra payment every single year, is to do bi-weekly payments. This will equate to efficiently paying that 13th payment without it feeling like your account is falling, here's a huge another $1,200 that I have to pay at the end of the year or sometime throughout that year. If we just do our payments instead of on the first, we just do it every 2 weeks, it will equate to a 13th payment. The other option too is just to make an extra $100 on this $200,000 loan at 6.5%. If we just pay an extra $100 every single month, we'll be almost roughly to that 13th payment, which equates to paying out instead of $455,000, right shy of $400,000, $399 and some change. And that equates to a few dollars short of $56,000 in savings. That is life-changing money. Also, if we think about it, if we're able to pay our mortgage off 6 years earlier, then that is free income that we can turn around and put into retirement, put into leisure, put into other things. Now, there are some pitfalls when it comes to paying off your mortgage early. Those equate to make sure that you pay off your higher interest debts. If our interest rate is 6.99 on a 30-year mortgage, most average credit card debt or unsecured debt is in the ballpark of about 16%. So we want to pay that off first so that we pay less interest even on those smaller debts. So make sure you pay those off first. The other thing is to make sure we're maxing out our retirement plans, our 401ks. If our employer is giving some type of match, a 50%, 100% match, up to a certain percent that we put in, let's make sure we take advantage of that free money that our employers are offering us. If we're only putting in 4% and the employer's matching 50% of that, then we're only getting 6. But let's say that that employer matches 50% up to a 7% put in. So max that out at 7%, get 3.5% from your employer, and now you're investing 10.5%. So just make sure you're paying off those higher interests and that you're saving for your future as much as you possibly can with that free money that our employers sometimes offer. And make sure we have an emergency plan. I discussed in a previous video about savings and that we need to have 3 to 6 months worth of our income into an account for an emergency plan. So when we look at it, we want to make sure that we have that plan and we're not just paying off our mortgage to say that we're paying it off. If something happens, if life happens, we must have an escape plan. We must have a safety net. So we need to make sure that we do that correctly. The other thing is to make sure we have the correct insurance, end of life. Make sure that you are leaving yourself and your families in a good situation. God forbid you pass earlier than expected. Life insurance, things as far as that nature, we must have those things. Even if we have a $200,000 life policy, that end of life policy will turn around and be given to your spouse, your children, whomever you put as the one to receive those funds. And they can take that and pay off the mortgage. They can pay off the debts. They can pay for your funeral. Last statistic I saw is the average funeral cost anywhere between $20,000 and $30,000. You don't want to pass away leaving a $200,000 mortgage behind and a $30,000 funeral for your family because you don't have end of life insurance, death benefits, things as far as that nature. And then one of the big things of paying off your mortgage that you need to be careful of is prepayment penalties. And this is something that you need to have the conversation with your mortgage provider, is to make sure that if you do pay it off early, they're not going to charge you to get out of that debt. And if they are, then you need to look at it and weigh that equation. How much is it? Is it a certain percentage of the mortgage? Is it a flat rate? We need to definitely look at those things. Paying off a mortgage will definitely free up capital, allow you to breathe a little bit easier, but there are other things that we need to make sure that we take care of. Paying off that student loan, paying off that automobile and those credit cards can make a life-changing savings for you. And if you are out of debt on those other things and you find out, hey, I am putting my max in on my 401k with my employer match, I am handling my life insurance, my end of life plan. And you know what? There are no prepayment penalties on the mortgage. Go ahead, work towards it, get debt free, live the life that you deserve. Do not allow debt to control you. Your money is an avenue to live a better life, to leave a better legacy for those that are coming after you. But you must be smart on how to handle debt. Stop using credit cards. If you have to use a credit card to pay for something, most of the time you don't need it, or you're not investing your money correctly. So I would recommend put the credit cards away, cut them up if you need to, put them in a bucket of water and freeze it to where you have to make a conscious decision. Or if you do take out a lot of debt, freeze your accounts, freeze your Experian, your TransUnion, those things that the creditors will look at to give you basically debt, to give you credit. Freeze those to where you have to make a conscious decision to take out debt, that you're not going to the store, and at the register they say, hey, we'll give you 10% off if you apply for our store credit card. If you have your TransUnion and all these other reporting agencies locked to where you have to physically contact them to unlock it, you can't make those knee-jerk reactions into increasing your debt. And so if you want to get to the point of where you have your freedom, make sure that you're taking care of these 5 things, then focus on the big one. This right here is financial freedom. This right here is generational, life-changing activities that you can do now to help your children and grandchildren. Hope you enjoyed. Share and like if you did. Leave a comment. And until next time, have a great day.